Hello, hi, this is Srinivasan from CFO Bridge yet again, and this time I am planning to talk about business planning. This is the month of February, March is coming round the corner, and then every businessman should be worrying about, or should be thinking about rather, what is he going to do in the financial year starting 1st of April 23 all the way till 31st of March 24. So this is the time when accountants and the promoters they get very really busy putting up a planning document. So I just want to share some thoughts as to what are some of the best practices, how the business planning can be done better. So, so the first and foremost thing is starting, right? Starting time. A business plan, ideally, the thinking about the business plan should have already started. But at least if you have not thought, if you have not started, please start now, and then conclude it well before 31st March, so that there can be few items that are requiring certain preparatory time, what we call as the lead time, and the ability for you to achieve your business plan will depend upon the item that is requiring longest lead time. Now, if you are supposed to have a few things ready on 1st of April, and if there is a lead time of, let us say, 30 days time of one of the items, that means your business plan should be done and dusted and approved and ready 30 days before 31st March. At least on 28th February it should be ready. Okay, so that you don't plan looking at the bigger things to lead time for the bigger things. It is the smaller thing that actually trips you and traps you. So you should look at what is the lead time for the smallest thing, and that has been my experience as well. That if you plan for the small things, big thing will definitely get taken care of. So please ensure that your business plan process starts and finishes well in time to take care of the lead time for the smallest item. Okay, so that is really very important. That's the first idea. Now, second thing is, what is a business plan? Right? Why we should do a business plan? Because I think it is more a statement of intent, and as I have learned long back, there is a statement, right, that vision without an action is a daydreaming, and action without vision is a nightmare. So if you don't have a budget or a business plan, then you will kind of have a vision and you won't have action, or you will have some action and won't have a vision. Budget is the process that combines both the vision and action. It aligns your action with your organization vision. Therefore, you need to have a budget. Okay, so that's the whole genesis of a budget document. So, and also it helps clarify and align all the stakeholders in the company. Then everybody is looking at what is called a single statement of truth. Truth is always one. Okay, there can't be, if there are more than one truth, then one of them is not true. So truth has to be only one. So there can't be more than one document, so that there is one document which everybody looks at it, saying that yes, this is the document that we are going to look at it. This is a document that is going to help me and empower me to act on it. So that's the reason why there has to be a document. And so the business plan, in these days time where business times are pretty dynamic, and there are a lot of demand, and then the changes are happening to the demand, changes are happening to supply chain disruptions are happening. So all kind of things are happening. Therefore, one should not plan beyond a financial year in these particular times. So that's your business plan span. Your span should be a financial year, and you can have quarterly rolling plans, and that's another way of looking at it. You can actually roll into the once your first quarter of this year is over, you can actually have a plan all the way going into the first quarter of next year also. You can always have a 4 quarterly plan all the time with you, and that's rolling plan approach is also fine. But in general, the span for business plan shouldn't be more than a year's time. That's first thing. Well, having said this, a year's time, you should also have, I recommend you to see a website called Long Now Foundation. It is one of the foundation. It is based in US, and there are certain really wise people. They are sitting there and they are thinking about what will happen to the humanity in 50 years time, 100 years time. It's called Long Now Foundation, and they are thinking about it, and they are many of their thought process is actually true, which has come true now, and they are able to advise and help various governments and other people to kind of be ready, be prepared for to tackle 50 years, 100 years time what will happen. So similarly, there has to be an approach to what will happen to your business at least 5 years time, 10 years time. What will happen to your business? Have an idea on that, and then fine tune that every second or third year. And so there has to be a short term view, which is your budget document, which is your handheld document, and then there has to be a long now discussion on what will your business look like in 5 years time, 10 years time. No need to spend a lot of time on it, but you cannot be completely blind to that also. So that's another part, very important point that you need to take care of when it comes to business planning. And then so now I am going into the actual process of preparation of the business plan. And one of the things that I want you to do is, I want you to imagine this following thing when you are sitting and preparing. Prepare a set of assumptions. It's very, very important. The assumptions are the unit cost of things that will move backwards and forwards, or where you will create many scenarios, what if scenarios, where you are able to move and they are the operating levers in your business. So please prepare a set of assumptions. A set of assumptions could be like, for example, what will be increase in your cost, what will be increase in your sales price, and how much you will be able to get sales growth, and how much you will be able to, those are all, and how many new geographies that you will go into, new offices that you will open. These are all assumptions. And these assumptions, because the reality will not necessarily follow the assumption, so you will have to have an ability to fine tune this. So for that purpose, you need to keep having different assumptions all the time. So you need to have a very robust process of tracking down what are all the matters that can be called as assumption. And please put a separate sheet in your Excel file and call them as an assumption sheet. It's really very important. Everything cannot be an assumption, and nothing cannot be an assumption also, right? There has to be something which is called as an assumption. So please look at various operating things and call them as your assumption, and have an ability to capture them separately. That's your first step in building a very nice, robust business planning document. And your second step is, please build separate component for or a separate sheet for each of the components of your business plan, which is revenue, your cost, your capex, your manpower planning. Every single aspect of that, please build separate components or separate modules for business planning. And then the assumptions will vary according to this. So drive all your assumptions from the assumption sheet, but please build separate components, and then so that you are able to kind of understand your components, how does it work through. So that's these are all things that you should have. And then you should have, you should ask your accountant or your CFO to prepare a simple, what is called an engine which calculates the assumptions into a business planning document. And then your accountant will know that it is very important to lock the engine file. The only thing that should be open to the entrepreneur or somebody else, a senior guy, is you should be able to play around with the assumption, and then you should be able to see the results. And so the engine of the business plan will have the following components: an assumption sheet, an engine sheet, and then a outcome sheet or output sheet. I think we should be able to kind of figure out. Then we will be able to robustly do what is called a what if analysis. This is just on the aspect of how to make an Excel file for business plan. Now there is one other thing. People put enormous amount of gory amount of details in making their business plan for their cost and revenue, their SKUs, their customers, the geographies, and all those things. But then the business planning stops at the level of EBITDA. No, hello, you can't stop at the EBITDA. There are items which are very important after EBITDA which are coming. So your business plan has to have a plan for the EB is earnings before, right? I, which is interest, T, which is tax, D, which is depreciation, and A, which is amortization. You have to have a plan for these things also. 90% of the business plan that I have seen, they do not have a plan for interest, they do not have a plan for tax. These are the money, external guys, they are taking money away from your business, which is the banker or the lender takes away the interest, and then the government, you have to pay them tax, and then depreciation and amortization is a result of the stuff that you have already bought. But depreciation and amortization is really important. Why you should look at depreciation? You can say that depreciation is fait accompli. I have already bought a capex, now this will happen. No, it's not fait accompli. It will tell you how much you have to set aside in this year. It is not necessary that your machinery, for example, if you have determined that its useful life is, let us say, 10 years time, it's not necessary that its actual useful life is also 10 years time. It's quite possible that there is, a particular piece of machinery which requires replacement, and if you are not clearly following your depreciation for that particular piece of machinery, then you are not going to have enough money to buy the asset at the right time. So everything has to be planned. You have to constantly review your assumptions for the useful life of the assets to calculate depreciation, and then you should have a business plan for your taxation also, how much taxation that you are going to pay. Once you start planning for your taxation, then you will know, are there any items of tax concession possible, are there any items of tax holidays, and those things are possible. They all can be properly planned out. And interest, very importantly, is the money that is going out. You got to have an assumption of how much you are going to pay to your lender, and you should freeze your interest rate that you are going to have there. If the interest rate actually moves up, because we are living in an inflationary environment, and if the interest rate moves up, then you should have an action plan, because you just can't say that interest increase is fait accompli, I'll have to give more money to my banker. No, then you will have to figure out how you are going to manage your profitability. So planning after EBITDA is really, really important. I have honestly not seen many companies having these items also being tracked out. Then also have a plan for your cash flow. And one of the things that people just generally don't look at it is apply for a lower TDS certificate. If TDS is your problem, take care of all these things under taxation and also on cash flow. Budget properly for your working capital movement and look at your cash flow. So every single item has to be planned. Most of the people, they just plan only for the income and the expenditure. We don't plan a balance sheet. We have to plan a balance sheet. Only way to plan a balance sheet is to have clear understanding of your working capital, what is really working, what is sluggish, what is moving slow, what is moving fast, so that working capital turnover ratio can be also be planned. And you need to have a good definition of your KPIs. Your return on investment, you will have to plan. You will have to put it in your planning document. What is the ROI that you are going to target? What is the working capital turnover ratio that you are going to target? How much of free cash flow you are going to generate? And what is the cash flow velocity, which is the, once again, kind of working capital turnover ratio. How quickly you are going to turn your money around in your current assets and current liabilities. Everything has to be planned for. So, that is what is called a comprehensive business plan, right? A business plan document has to have those assumption, output, and the engine sheets. Then you should also plan for items that are coming after EBITDA. Then you should also plan for your balance sheet, and you should also plan for the key outcome of your budget. You should plan for how much money the entrepreneur is going to make, right? I think, most of the entrepreneurs, they don't have an eye on it. You should plan how much money you are going to make in this year. Therefore, what's the ROI, what's the working capital turnover ratio, and they are all really, really important. Then it becomes a comprehensive business plan. Okay, so that is just one more thought that we wanted to share with you. And while you are making a business plan, I also encourage you to look at your competitors' financial statements. Look at your competitors' financial statement and see what are the best practices that you can actually pick up. How can you benchmark your operational excellence, your costs, and your sale prices, and the customer segment that you can do, and what are the strategies. Sometimes, in the case of, if there is any competitor of your company in the listed space, please go and download their analyst presentation. For the same company, if they are a listed company, then you need to share with the stock market what is your strategy. You got to give a lot more information, and you can just simply use them and then validate your strategy as well, right? There are really superb documents available in the public domain. So if you have got a competitor, and don't just say, no, he's very big, he's listed, why should I compare them? No, you should compare them, because the data is presented for stock markets and analysts, so it is well presented. So you will have a lot of ideas from there. And look into their analyst presentation, which is a PowerPoint presentation, which will have a lot of information about their strategy, about their risks. So you can have a lot more. You can actually have a complete playbook for how to run your business if you are able to track one of a listed company as the company to benchmark all of your operational and financial parameters. So you can do that. And then one of the approaches that you can do is about zero-based budgeting. A zero-based budgeting is a concept that completely is kind of forgotten. The best way to think about zero-based budgeting is to say that all there will be no assumption overload or an assumption carry forward from what you have been doing in the last year. So, which means basically every single assumption you will fine tune, recalibrate, and you will ask questions saying why 15%, why this much number, why this more, why can't be less. So, every number you would have to ask the question. That rigor is called zero based budgeting. So, I think, so this is what I call as my planning podcast number one. I will follow more in rest of the podcast. Thank you.